Welcome. I'm Jeff Huge, Chief Investment Officer at JWH Investment Partners and founder of Alpha Insights. And this is your Daily Five. Daily Five is um, it's the show where we go through the five most important charts that are really just top of mind to us right now at the market. Before we get started, I wanted to just do a quick, reminder about our upcoming investment newsletter for those who are not indoctrinated. Let me just tell you a little bit about it. First of all, we publish a monthly newsletter, and we've been doing it for about 2 years. That newsletter is available on Substack. It's free to subscribe, and it's delivered directly to your email on the first Saturday following the non-farm payroll report each month. The newsletter is affectionately entitled Huge Insights, the Big Picture. Therein, we go through a number of key macro factors and our general investment thesis for what is impacting the economy and how it's going to play out in the markets. And for those who want more, there's also an option to upgrade to paid for as little as $12.50 a month. That includes our monthly market forecast and positioning recommendations. And paid subscribers also receive our weekly Alpha Insights Idea Generator Lab publication. That's an institutional publication that is part of our institutional advisory service. And basically, it details our top actionable trade idea each Wednesday and also provides some additional updated market commentary and, kind of an investigation into sector rotation each week as well. In addition, our paid subscribers are also able to access certain privileged interim bulletin reports when they're available. And we also send out a quarterly video that goes through our top-down investment thesis in great detail. It's usually a recorded version of a keynote address that we've made at a conference recently. The next publication is actually scheduled for September 2nd, so that's coming up soon. So if you're not already signed up to receive the newsletter, you can go to hugeinsights.substack.com and just enter your email address, and you'll be on the distribution list for the September 2nd publication. Okay. With that said, let's just review quickly our last episode. The last time that we were on Stock Charts doing a Your Daily Five episode, it was on July 27th. And at that time, we indicated a major trend reversal appeared near at hand. And just to go through what we talked about, we discussed at that time the new extreme and bullish investor sentiment from both professional investors, that's the buy side, and individual investors. We also highlighted the bearish negative momentum divergence that was evident in our 10-day momentum study of the S&P 500. We explained the impending rise in volatility based upon seasonal factors. And we also presented Ned Davis's Cycle Composite data, which indicated basically a period of expected decline for the S&P 500 between late July and late November. And we're going to review that today as well. And finally, we stated very clearly in no uncertain terms that our expectation was for the counter trend advance in the S&P 500 to top, and that it was poised to reverse trend to the downside. And so far, that analysis appears to be correct. Chart number one that we wanted to go through in this week's Daily Five looks at investment advisor sentiment. That's different than the name exposure index and the AAII survey that we talked about last time. It actually is more of a cohort of researchers, professional investment advisors, much like myself. In fact, my opinion is included in this data. There's hundreds and hundreds of newsletter writers and sell-side research publishers that are included in this survey. And the bullish investor sentiment among professional investment advisors actually peaked in July at 57.1% bulls. That was just below the 57.3% level that coincided with the top in the NASDAQ complex back in November of 2021. But the bearish sentiment among the same cohort is now actually lower than it was when the market hit its all-time highs. It's just 18% right now. And historically, troughs in bearish sentiment are powerful, especially among this group. They have tended to precede important market tops and major trend reversals in the market. And we think that this ranks very highly as being consistent with our view that the bear market rally has terminated. Let's take a look at the Cycle Composite work once more. We believe that the Cycle Composite has now turned down. This is a combination of three different cycles that's put together by Ned Davis Research. They look at the 1-year seasonal cycle, the 4-year presidential cycle, and the 10-year decennial cycle. The blue line represents the Cycle Composite's expected path and cumulative forecast return for the year. Now, as you can see on the right-hand side, the forecast return is only 10.5%. And what we've seen so far at the peak, indicated by the gold line, which represents the S&P's actual path and cumulative actual return year to date, we peaked at almost 20%, so more than double what the expected forecast return was. Now, what we did is we actually put a line that would indicate where 10.5% is in red. That's kind of right in the middle. You can see it. We've put a big 10.5% there. And what we're saying basically is if the S&P 500's actual return, this gold dotted line here, were to come into line with this 10.5% forecasted expected return, we could see the S&P down around here. And this gold line could chop sideways and perhaps even fall below that 10.5 and then rally back into it into the end of the year to achieve that. I think what we're likely to see is a lot of volatility over the next 2 to 3 months. And, at this point, we're looking for the market to put in a tradable low probably in late November. And so with that in mind, expect continued volatility to the downside between now and then. This is probably the most important chart in the deck, chart number 3. It looks at the daily range of the S&P 500 going back to the January 4th, 2022 highs, where we believe the S&P 500 put in what is very likely a cycle degree peak, and by extension, a super cycle degree peak. We're calling it super cycle wave 3. That would be the high. And so, the expectation going forward is that we're going to correct super cycle wave 3, which was a 90-year advance off the 1932 low that peaked in 2022. The decline that we saw so far into the October 13th, 2022 lows, that was only primary wave 1 down of a 5-wave impulse decline that we will expect to complete wave A of a ABC corrective move that could take many years to complete. We think that the expectations in the market do not consider the long-term structural issues in the S&P 500 index itself. And we've gone through this before, and I'm not going to belabor the point. I really want to focus on what we're seeing here in the near term. And so just to kind of describe the price action going into that October low, we saw the market trade down in 5 waves. It was a 5-3-5-3-5 decline. That is a motive wave, and it counts best as a leading expanding diagonal. Now, that is a fairly rare pattern. We don't see it very often. We haven't seen very many of these at this degree of trend. I'm aware of 2. And it was discovered by A.J. Frost and Robert Prechter, who wrote about it in detail in their 1978 classic Elliott wave principle. One of the things about this count that is interesting to me is it's one of the only counts where wave 4 can enter into the territory of wave 1. And that's what we see. The intermediate wave 1 decline ended on February 24th. And the intermediate wave 4 advance ended on August 16th. And we can see clearly that wave 4 here entered into the territory of wave 1. That's only allowed in a diagonal triangle pattern. There's 2 types. There's a a leading diagonal of contracting variety where everything kind of contracts into a period. And then there's the expanding variety. And that's where we get kind of this expansion here where it's a widening. Now, the rules that Prechter and Frost identified for the past two observed leading expanding diagonals was that wave 5 should be the longest wave, and it should be longer than wave 3. That is a problem right now because wave 5 has fallen short. It did not exceed the wave 3 distance in terms of the number of the points, S&P points from the wave 2 to wave 3 high actually were not exceeded in the wave 4 to wave 5 low of this pattern. And so, we look at this as kind of being a possible problem having fallen short. That being said, there's only two other counts, and so we can't be definitive about that. It's also not even discussed in R.N. Elliott's original work, so we can't really say that it violates one of Elliott's rules. What we can say is that it appears to have ended a leading expanding diagonal triangle, and with this kind of caveat that we fell short on the fifth wave. What we've counted since is 5 waves up, 1, 2, 3, 4, 5. That is wave A at intermediate degree. We have a flat corrective waveform here, ABC, which ended intermediate wave B on March 13th at the end of the banking crisis. And from that point, we traced out 5 waves up. But this was a little bit contentious on the way up. We counted 5 to 1, a 1, 2, 1, 2, 3, 4, 5, 3, A, B, C, 4. And then we started getting a lot of subdivisions. We saw a 5th wave extension where we got wave 1, 2, then a 1, 2, 3, 4, 5, wave 3, 4. And then the 5th of the 5th wave also extended 1, 2, 3, 4, 5 to give us a very complicated wave C. And so it made kind of identifying the peak somewhat elusive. I mean, we had multiple counts trying to figure this out. It was very, very difficult, but we think we solved the Rubik's Cube, and we think that the market topped at primary wave 2 on July 27th. And since that time, we've counted 5 waves down, 1, 2, 3, 4, 5, into the August 18th low. We believe that's minor wave 1 down of a 5-wave impulse pattern that will ultimately trace out intermediate wave 1 of primary wave C. Now, the rally off of this rallied back into resistance, and that resistance kind of came in right around the 50-day moving average here, this green line, that's the 50-day, and that halted the advance in its tracks, and we've subsequently seen a pullback off today's high. Now, if that holds, we can label that minor wave 2. And what follows minor wave 2 is minor wave 3. And we think minor wave 3 will take out this gap resistance level, probably take out the 4,200 level, and will very likely take out this trend line and the 200-day moving average before it terminates. Let's take a closer look at what that could potentially look like. So we're really just blowing up the S&P 500's recent price action. This is a 3-month look back at the 120-minute range chart. That's 2 hours. So each bar is 2 hours of price action. And we can see how we topped here in 555 of C, primary wave 2 top. This is the July 27th high right here. And this is the August 18th low. And so what we've counted down from that, from a very short-term perspective, is 5 waves down, 1, 2, 3, 4, 5, to this August 18th low of S&P 4335. Now, from there, we see that the rally has probably counts best as a double zigzag. We get kind of an A, B, C, W, X, A, B, C, Y to complete minor wave 2. We retraced more than the 38.2% retracement, the Fibonacci level, and we came up short of that 50% retracement, a pretty common reference level. But we did kind of get to the top of this parallel trend channel. And that gives us some confidence that we've probably put the top in. But the most important thing here is that the decline off of that minor wave to presumed high has already taken out the intermediate wave, minute wave W high. And so that break below this level gives us a lot of confidence that minor wave 2 is complete. And once we take out this low here at 43.35, that will confirm it. And that should get us all the way down to at least gap support at 42.40. But it's our view at this point that minor wave 3 should carry to a minimum target of S&P 4050 before the next counter trend advance of any significance really ensues. And how do we get there? Well, there's an interesting head and shoulders dynamic here too. So once we take out this low, we'll have kind of resolved below this head and shoulders top. It's a classic pattern top formation. And the count would be the distance between this high and this low. And that gets us down to around 4,050. And so assuming that the pattern resolves in that direction, we think it's a good count to get to 4,050 to end minor wave 3. We'll then see a minor wave 4 counter trend advance, most likely a lateral consolidation pattern. We would expect a triangle at this degree of trend, and then a final plunge down to complete intermediate wave 1, which will be some weeks in the future. Possibly this carries out into November. So let's keep that in mind. Now, what makes us so certain about this? Well, slide number 5 looks at two different versions of the stock market. Most people are used to just looking at the S&P 500 or the Dow. Some people are more focused on the NASDAQ. And no question, if you look at the S&P or the NASDAQ, it looks completely different than this. And that's because the concentration of those two indexes are really focused on 7 stocks. Those stocks are Apple, Microsoft, Amazon, Google. Now NVIDIA is the number 5 largest stock in the S&P, Tesla, and Meta. Those 7 stocks account for around 28 or 29% of the S&P 500, give or take. And if you look at the NASDAQ, they're more like about 48 or 49. They rebalanced the NASDAQ, so it's below 50% now. But nevertheless, they're highly influential on those cap-weighted indexes, and that caused the S&P 500 to extend back up to nearly its highs. It retraced about 84% into that July 27th peak. But if we equal weight the S&P and take the emphasis off those 7 mega cap names, we've got a completely different picture here. In fact, we can see that same expanding diagonal triangle into the lows, and it actually counts almost perfectly. It's still just a little bit short, but it's not quite as truncated as the cap-weighted version. So, we still fell short, but it looks pretty good to us. We also retraced at Fibonacci 78.6% to the penny, okay? And when I say to the penny, I mean, we got an ABCW, ABCX, ABCY to the exact 786 retracement. And that completed primary wave 2. And now we've fallen hard down. We've held so far at the 200-day moving average, which is also kind of the minor wave A of this ABC in intermediate wave Y. But a breach now below that 200-day moving average, below that prior high, would take out this trend line that connects the October and March lows, and I think would set the equal weight index up for a decline hard down in primary wave 3, which should carry to significant new bear market lows. Now, another way of looking at the stock market is kind of taking a look at a broader version, not just the top 500 stocks, the best of the best, but let's look at 1,700 stocks. And we'll look at the value line index. Okay, this is the value line geometric index. It's one of the oldest stock market indexes, goes back to 1960, with that degree of breadth. It exceeds the Russell 2000, for example, going back much, much further. And so the data is very, very interesting to us because the geometric average actually looks at the median daily price change. And so the index is much, much more representative of what the median stock is doing from day to day, not just those top seven, kind of AI hype stocks. And the value line index really has come down dramatically. Not only has it fallen in 5 waves that are very, very typical of an impulse pattern. We have a 1, 2, 3, 4, 5, with an extended third that also fell in 1, 2, 3, 4, 5 to complete wave 3. So that primary wave 1 down is a little less convoluted because of this, esoteric pattern that there's not much history behind. We're really confident that this impulse pattern represents 5 waves and that it's primary wave 1 down. We can also see a clear zigzag ABC to complete primary wave 2 up at a shorter time interval and a near 61.8% retracement. So, we think that's a much more typical Elliott wave pattern. It also terminated right around a prior 4th wave high, which is a very common place for these sort of corrective waveforms to terminate. And then subsequently, we saw another 5-wave decline in minor wave 1 and a clear ABC. It was kind of an ascending wedge pattern from a classic technical perspective to complete minor wave 2. And now we've broken down. But what's most interesting is that the market today is now trading below both the 200-day moving average and the 200-week moving average, which is actually above the 200-day moving average, which is very, very consistent with a bear market, right? And so we believe that as we see further progress, take out this minute wave B of minor wave 2, that will confirm that primary wave 3 down is very much in progress. And so we're spending a lot of time focusing on indexes that are not mainstream S&P 500, NASDAQ 100. I mean, if you're trading the Qs or the SPYs, or you're trading futures around the price action in those indexes, yeah, you're fine to trade the trend. But if you're an investor and you own individual stocks, which are going to be heavily influenced by the market itself, you want to spend more time focusing on the broad market to see what's happening. And this is not price action that is indicative of a bull market advance. No. This is price action that is indicative of a corrective move or a counter trend advance within the early stages of a larger degree bear market, which we believe will ultimately trade out at super cycle degree. So we're going to leave it at there today, guys. And with that, if you'd like to follow up with me in any way, you can reach out by going to my website, jwhinvestment.com. You can follow me on Twitter as well. We do put some content out there for free at alpha_insights. And most importantly, get on our newsletter distribution list. Go to hugeinsights.substack.com. Put your email on the list. Get our next email that comes out on September 2nd. With that, I want to thank you very much for watching and wish you the best of luck trading.